Danielle, my timing is not usually this good, but how timely is it to have an expert on the Federal Reserve on the webcast today, and someone who has years of experience working there and decades of experience studying all aspects of central banking? So, on popular demand, I have Danielle DiMartino Booth with me today. Danielle is CEO and Chief Strategist for QI Research, a research and analytics firm, and she leads a core team dedicated to providing critical analysis on what is driving the financial markets at any moment in time, with Fed policy again, her stock and trade. Since her firm's inception in 2015, the commentary and the data analysis from her Daily Feather and the Weekly Quill, both must-reads, have impressively penetrated the Wall Street landscape. Prior to her current firm, Danielle spent nearly a decade at the Dallas Fed. She served as special advisor to then President Richard Fisher. Prior to that, she spent her career in the industry as a fixed income and equity market analyst at DLJ. And in 2017, Danielle published a central bank Bible titled Fed Up, which serves as an insider's guide on the Fed, and which I'm honored to say I was quoted in. And for that, Danielle, I'm eternally grateful. Danielle is going to walk us through her current views and on this current mess over at the Fed, how all this plays out, the economic and market repercussions from all the political interference that is taking place and seemingly set to gather steam into next year. Danielle is going to share some slides with us in the process. When she's finished with her remarks, we'll open the lines for questions. So please press the tab if you have any. And as usual, we'll turn this into a fireside chat of sorts. So Danielle, over to you. Thanks in advance for coming on the call, all the way from Italy, where I think it's 10 p.m. your time. So an extra thank you for staying up late for us. Over to you.
Well, first off, Dave, there were very few people quoted in Fed Up who were not Fed officials. The joy of writing that book is that I had to write so little that they provided so much material for me, and getting to quote them was very, I think, eye-opening for most of the people who read the book. But yes, you are one of a handful, literally a handful of people who was quoted in that book, and well-deservedly so. You were an inspiration to me before I even said I have 4 children, which I do now. I knew you before 4. In any event, yes, let's jump right in. I want to give you the backdrop of the life right now as from the perspective of a Washington, D.C. based Federal Reserve staffer. Now, we're talking about 14-year terms, and is Powell going to stay through the end of January of 2028? Is he going to do what Mariner Eccles himself did in 1948 when Truman pushed him aside his chair, and stay on as a governor of the Fed to safeguard, to the extent that he possibly can, the independence of the Fed? We will find out, and we'll find out in just a matter of months. But regardless of who is in and out of positions, with Governor Lisa Cook, whose term is set to expire at the very outset of all sitting 7 governors right now in 2038, the Fed staff still tends to outlast even governors, and especially district presidents. So let's have a look with the first slide at what they've been contending with while Chair Powell, to extraordinary unity on his Federal Open Market Committee, has maintained until Jackson Hole that the labor market is quote unquote solid. Let's have a look. So the first slide shows you that in the second quarter of 2024, the second quarter of 2024, we had net job losses in the US economy. This is a back check against the imputations that are delivered on every non-farm payroll Friday by the Bureau of Labor Statistics that are influenced, if you will, by the birth-death model, by, as we've been reading about, falling survey response rates. But when you compare those to the 12 million US employers who, by law, on a quarterly basis, have to report to the census their headcount, you see that in the second quarter of 2024, job destruction began on a net basis and to a deeper extent in the private sector. Now, Economics 101 tells you I'm going to go back to Lacey Hunt. Economics 101 tells you two things. What are the two most lagging of all indicators? First in line, unemployment. Second in line, inflation. Way of the world. Or if you want to use the David Rosenberg-ism, what leads the economy in and out of recession? Housing, every time. But sticking with the labor market, we had net job losses in the second quarter of 2024. What does that mean if unemployment is lagging? That means that the National Bureau of Economic Research, every single member of whom, that this is the Business Cycle Dating Committee, is an Obama appointee. I bring this up because the environment that we're in is very politicized. So I ask you the question, if we know that recessions begin before net job destruction, why on earth haven't we heard from the National Bureau of Economic Research that recession began in the first quarter of 2024? Continuing on with this one slide, the second slide shows you that in the third quarter of 2024, we again had job destruction. There was, as you know, euphoria that accompanied the US presidential election. It proved to be short-lived. Everything that we know right now suggests that the US economy double-dipped back into recession in the first quarter of 2025. Again, this is not Danielle. This is not my opinion. This is not anecdata. This is the hardest data that exists from 12 million US employers that has been provided to the Bureau of Labor Statistics and reported with a massive lag. So let's fast forward. Let's fast forward to, we've just left Econ 101, right? Unemployment and inflation are the most lagging of all indicators. What else do we know about economics and statistics? How did, and I want to say this very carefully, how did the current administration mess up calling out the BLS? Well, it's one of two things. A, the systematic endemic challenges facing the efficaciousness of non-farm payrolls began long before the former commissioner who was recently let go by Trump. 24 of the 30 months ended June 2025 were revised downwards. That is not a statistical anomaly. The tails are not long enough to explain how very endemic revisions had become. Furthermore, and this is from my discussions with my good friend over at Bloomberg, Anna Wong, what was bizarre about the few breaks that we did have in the negative revision stream was that in July of 2023, that negative revision stream broke, but only because of an upward revision to government jobs. Government jobs are not surveyed. They're provided directly to the Bureau of Labor Statistics. There's just, call it a bat line. There's no, there are hard numbers. And yet in July of 2023, we saw that we had 130,000 positive net revisions to payrolls that overwhelmed the negative 12,000 in negative revisions to private payrolls. So then the string of negative revisions continued. The second slide you're looking at suggests, and I say suggests because we actually don't know what the new Bureau of Labor Statistics is going to report on September the 5th. We hope We hope that the integrity in the data will be maintained, but we have no idea. The president himself just came out on Tuesday and said he expects that this next job report is going to show that hiring has gone through the roof, which we know has not been the case when you look at Google Trends and the number of Americans who were searching for unemployment benefits at the highest level that we've seen in well more than a year, pushing 100%. Neither here nor there. A little curiosity about the difference between the Bureau of Labor Statistics on a national level and that of individual states plus DC equals 51. When you aggregate all 50 states plus Washington, D.C., what you find is that rather than the deeply revised positive 14,000 non-farm payroll jobs in the month of June 2025, we actually saw a print of negative 65,000. If we could go back to that next graph, that last graph one more time for just a second, I'll jump through this quickly. When we have a negative print in aggregate state payrolls that we have just seen, state payrolls are reported with a 2-week lag to that of national. When we have a negative 65,000 print, historically speaking, on the national side, upon the event of the second revision, there's a 67% probability that we see that positive 14,000 at the national level revised into the red. That is what you should expect, or at least a 67% probability, historically speaking, of what you should expect when on September the 5th, June 2025, the second revision is reported. But of course, we get revisions with non-farm payrolls. We do not get revisions to the U3, to the U6, to the unemployment rate, to the underemployment rate. We do not get revisions. Instead, as you can see in October of, well, I'll point it out for you. In October of 2013, the survey response rate for the unemployment rate was 90.1%. This last July, it was 67.1%. And yet, these are data that are never revised. They go into the history books in blood and are never revisited. Compare, if you will, then where the unemployment rate is vis-a-vis the response rate, and tell me if you're seeing good data. If you prefer, look through the prism of the University of Michigan. Look at the skyrocketing size of its survey. It's absolute, that yellow line, it's gone way up at the same time that we've seen, again, the response rate for the household survey go down materially. What does this tell you about the 62% of Americans who say in the next year, University of Michigan, when I'm queried, I anticipate the unemployment rate is going to rise? These two series used to have a Huggy Bear 0.9 correlation. They moved in tandem. One moved with the other, cycle in, cycle out, cycle in, cycle out. Recall, University of Michigan data dates back to 1968. So we have many cycles we can look back on. And what we know is that the University of Michigan sample size has grown appreciably since it's gone online. Anything north of 50% in terms of higher unemployment expectations, you are inside of recession, not flirting with recession, not contemplating recession, inside of recession. That number right now is at 62% as of the first look in August. And to that, we have a withering response rate in the unemployment rate. Keep these things in mind because in theory, the Federal Reserve is supposed to make monetary policy using these data. Let's jump to the next slide. So here we are. You know, hyperbole is overused. The word bubble is overused. But when I saw this Morgan Stanley graph recently, I did stop and pause. It is not natural. Okay, maybe not everybody has 4 kids like me. Maybe not everybody has 3 kids like Dave. Maybe we're just really ambitious little bunnies. But it is not normal to not move out of your parents' home and start a family. And yet, the share of young adults living with their parents today is at the highest that it's been since the Great Depression. Rentership rates, that green line on the right-hand chart, look at that. In the post-pandemic era, we have seen rentership rates increase. We have seen homeownership rates decrease, net, all households. We've actually seen a slight deterioration in the number of homeowners. I bring this up because, again, I bring up Rosie's rule number one. Housing leads the US economy in and out of recession, in and out of expansion. And housing has this gorgeous ripple effect. When you set up house and home, and then you have a baby, then you need a nursery, you need baby clothes, you need all kinds of things. And then you have a second baby. And even if you stop there, you might have to move up to a bigger home. This virtuous cycle, if you will, has been arrested in the post-pandemic era. This virtuous cycle has been arrested, actually, since, call it the Korean War. We can toss around the whys of it. We can talk about labor force participation rates declining. But at the current juncture, Federal Reserve Board staff in Washington, D.C., seeing hard revisions to non-farm payrolls, seeing what they're seeing with state aggregate payrolls, knowing that we have rentership, knowing that housing affordability is absolutely, continues to be completely impairing. And then we pull up this next slide, right? Because there's two mandates, the employment mandate and the inflation mandate. All right, so let's talk about essentials. Let's talk about food at home CPI, lowest level in a year, that yellow line. Well, if food at home is so much less expensive, then why on earth is inflation-adjusted consumer spending for services, net of service essentials, net of housing, net of utilities, net of healthcare, why is that at the lowest level on a year-over-year basis, in the negative, at the lowest level since the Great Depression? If food is so cheap, relatively speaking, compared to a year ago, why aren't US households spending more on discretionary services? It is extraordinarily rare to see discretionary services spending decline. And that is indeed the road on which we find ourselves, as inflation in this area of the economy has turned negative to the greatest extent since the Great Recession. There should be a question mark. Paging Powell, if not essentials. Why not discretionary? Question mark, Chair Powell. Now, I don't envy Jay Powell. I will say that given the abundance of data that he had in hand, that he has had in hand, the fact that he knows Richard Fisher very well, the fact that he sees my research, why has he maintained that the labor market is solid for as long as he has? Is it purely to spite President Trump? I've certainly been critical of that in recent months, but there are extenuating circumstances that we absolutely must incorporate into our analysis. If we can jump to the next slide. We have, not only do we have a bad breath, B-R-E-A-D-T, I brushed my teeth before I came on. It's a podcast, right? You can't smell it if I had bad breath, but I did anyways. We have a bad breath, B-R-E-A-D-T-H problem, when really in the 21st century, anything north of 40% of industries that are not hiring lands you in recession. We're at the 50% threshold right now of the 126 payroll industries. The reason the threshold has fallen, by the way, now think of buggy whips in 1920, right? The buggy whip industry stayed as a standalone industry well after we were all driving cars. It took a while for that industry to die off. But in that same sense, the 126 payroll industries that we have today have been overwhelmed by technology type of employers, by services employers. In other words, the lower threshold means you don't have to cross 50% before you're in recession, 50% of industries that are not hiring on a month-over-month basis. The threshold is actually lower, closer to 40.6% to be precise. So you have fewer industries hiring. So this should make Jay Powell question, but it is the demographic aspect that I want to bring to your attention today. The demographic aspect that has Chair Powell in a tight spot, that will put even the most dovish future chair of the Fed in a really tight spot. One that could make them rethink being a political patsy. One that would make them, not for the sake of reputational risk, but for the sake of not wanting to be hunted down with pitchforks. It comes down to this chart on the right. We've all heard about the plight of the class of 2024, which is only bested by the plight of the class of 2025. These kids cannot get jobs, which is why new labor force entrance, that green line, is, to use a technical term, in the toilet. At the same time that we know that we have 11,553 US baby boomers retiring on a daily basis, in addition to the continuation of the white collar layoffs that we're seeing. So labor force exits are appreciably higher than labor force entrance. Well, so what, Danielle? Who cares? Let's go to the final slide. You see, I'm repeating this here for a reason. It's called the 401k. It's called the 2/3 of every dollar that flows into the market being passive. In order for passive to function, if passive is going to function, you must have three critical elements. You must have new entrants outnumber exits, and a stasis in individuals who continue to contribute to their 401ks, such that your net contributions via 401ks at the 1st and 15th of every month, when people get paid and they automatically flow into target date funds, right? The largest target date rebalancing date in the history of mankind happened to coincide with May the 23rd, 2020, when the Fed came running to the rescue. It was not the Fed, ladies and gentlemen, it was not. It was the fact that the markets had melted and it was a quarterly rebalancing, and a machine said, Joe Schmo, Jane Schmo, they're 30 years old. They should have 70% of their portfolio in stocks. Why on earth is it 50%? Make that 70% again. And so we had trillions of dollars flow into the US stock market in one day. Reverse that thinking today, right? We've got 14.2 trillion, give or take, enjoying what had been higher for longer, which has segued into high for long, which, by the way, still carries the baggage of a lag effect. Nobody wants to talk about record bankruptcies. I don't have a slide on that. We don't have to go there. But focus on the money being collected today at 3.5%. Ballpark it with me. Let's defer to the fine Treasury Secretary Scott Bessent and his wishes that the Fed funds rate should be reduced by 150 basis points. Pray God, by the way, Bessent gets his way and not Trump, who's called for double that in rate cuts. Who cares, Danielle? Well, I tell you who. Savers. In 2001, in 2007, baby boomers were a heck of a lot younger. What did they do when their portfolios got shellacked? They said, you know what? I'm going to go work for Southwest Airlines behind the gate. I'm going to go be a Walmart greeter. Yeah, 60's the new 50. And then they went back into the workforce. We see it. We saw it in the labor force participation rate for Americans over the age of 55. Not once, but twice. We saw a massive inflow into this demographic rejoining the workforce. The median age of a baby boomer today is 71 years old. They're not returning to the labor force. My mother happens to be the outer edge. She turned 79 in 2 months. She'll turn 80 next year. She is not rejoining the workforce. Americans who are 70 years and older own 40% of the US stock market. Americans who are 70 years and older own 25% of residential real estate. Treasury Secretary Bessent, take your 150 basis points and say a prayer. Because for every 50 basis points, you're taking $71 billion out of the hands of savers. Go the route of President Trump, knock it down by 300 basis points. You unleash the gates of hell. You do not want the 40% of Americans who are 71 years and older, who define the median baby boomer. You do not want them to sell their stocks because they will test the automated passivity in 401k contributions. They will scare small investors. Nobody wants to put, I was Fed chair when I stress tested passive by lowering the Fed funds rate too much and failed and oops, blew up the financial system. Nobody wants to put that on the resume. I don't care how much of a yes man or yes woman you are. Nobody wants to put, I blew up the financial system on their resume. That's about all I have to say.
Okay, well, thanks, Danielle. That was great. Lots to unpack. I guess I'm just gonna pose initially some direct questions since you are the quintessential Fed watcher. So these will be just direct questions. Is the Fed easing on September 17th? Yes or no?
Well, it's my birthday, they better, but think I think if the payrolls data are flattered on September the 5th, that 25 basis points is as far as they're going to go.
So you think they're going to be one and done if they cut?
Well, I'm sorry, I misunderstood the question. I thought you were asking me about 25
Oh,
or
you said
50.
that's as far as they're going to go. Oh, you mean 25 and not 50? That's what you're saying.
Yeah, I mean 25 and not 50, despite the fact that
Okay.
there's accelerating disinflation morphing into deflation in rents and housing. That was our daily feather today. But yes,
Okay.
despite
So,
that.
so next question is about the detonation. What do you think the low will be in the funds rate for the cycle? What level are you looking at?
Even the dissenters, and especially Waller, does not want to see anything south of 2%.
Okay, but I'm asking you, what is your call? 2% at the which I guess would be, look, it's not that outlandish a forecast. If inflation gets to 2, real rates get to 0.
Mhm.
I mean, I think you're pretty well already there in your in the euro area.
No,
You
I do
2%.
I do anticipate getting to 2, and hope makes an ass out of me. Oh wait, that's assume makes anyway, forget it. I'm mixing metaphors, but I do hope we stop at 2. If we go to zero bound, Dave, you can go back to that very last slide.
Well, yeah, well, I know
You'll
if we go
force
to
the baby
0,
to sell.
well, when we've gone to zero bound in the past, it was under a completely different set. I mean, that wouldn't just be about the economy. That would be about the stock market and credit spreads.
Right.
Um, so I just wanted to get what your feeling is. So, we've had this fairly dramatic steepening of the yield curve. The long bond in particular has been a no man's land, pretty well the only part of the treasury market that hasn't been rallying at least some. And you've had this fairly substantial increase in the term premium since the spring, uh, which is part and parcel of the steeper curve.
Mm-hmm.
And so the question I would have for you, since you are a market seer, is how would you benchmark what the long bond and 10-year note are going to look like by the time we get to that 2% funds rate in your base case forecast?
So Dave, right now we have two forces battling one another, right? We have this whole, the United States cannot stop spending like a drunken sailor. So that should put a floor theoretically underneath those long maturity rates. But my view, Dave, which is fairly contrarian in nature, is that if the economy gets bad enough that we have to go there, the rest of the world is going to be no better off, probably worse. And you will end up having, and I'm going to sound like I'm 2 times my age, you will end up having the safe haven trade finally come in. Recall, the narrative right now, and part of what's keeping long maturity rates high is the 50% or so of volume attributable to gigantic hedge funds who are short these bonds. But if 2's the new 0, if the 2% is the new floor as opposed to the 0 floor, I think we get a lot closer to 3% on these yields. Even the long bond today was what, 489? It's supposed to be going up, not down right now, by the way, the yield. And yet the force of gravity is not something that we can necessarily deny, but right now Fed policymakers are in deep denial about shelter deflation. And the longer they ignore it, as my good friend George Goncalves says, the more they're going to have to make up for it by being aggressive. But in that set of circumstances, it really is the real economy that not huge hedge funds, but the real economy that dictates long maturity yields.
So you're saying that we can get as low as 3% of the 10-year, and what would you say in the long bond?
I'm going to defer to Lacey right now. I'm not going to put a number on it. So there.
You're not going to put a number on it, but we're forecasters.
We are forecasters, and I do see downside to the yield right now. And I think that one of the biggest curiosities, in fact, I mentioned this to a client today. I said, the harder the media bangs the table on the danger of long maturity yields rising, the more they seem to resist it. And isn't that ironic?
Okay. I just find it interesting that you did mention, I think, roughly 3 on the 10-year.
On the 10, yes, I did.
But you're withdrawing guidance on the long bond.
Let's just say,
it might be a story in its own right.
let's just say that the long bond, despite the fear, appears to have a ceiling, and it's getting multiple concussions because every time it hits 5%, it has to go back to the ER.
Well, we're close to 5% now. The question is, where do you think will be in your, and I want to get a gauge of what the yield curve is going to look like. 2% funds, 3% 10-year. Is it 2, 3, 4? Is that what we're talking about?
It could easily be, Dave.
2, 3, 4. I'm having Danielle down for 2, 3, 4.
God help me. Okay, somebody get out a laser gun and okay.
I didn't ask for a decimal place. Okay,
Thank you.
let me ask you a question. This is very interesting because one of our competitors in this, call it consulting business, was on one of the financial media shows this afternoon and said that on the equity market that we're in a bull market. But almost all of the gains in the S&P 500 this year have been wiped out by the weaker dollar. The trade weighted dollar is down more than 8%. For something that is normally stable like the DXY, I don't think people understand how down 8% in 8 months is like a coronary. Yet, banging my head thinking, when you're taking a look at relative growth differentials, relative interest rate differentials, and usually the country imposing the tariffs is a country that normally sees its currency appreciate. But not this time. And this is not a normal decline in the US dollar. Nobody talks about it. Everybody thinks we are in this incredible risk on bull market, Bitcoin and the stock market, now the small caps, credit spreads. But I've been thinking for a while that something doesn't smell right in Denmark. Not that I know what the krone has been doing the past little while, but let me just say that how do you make sense out of that? Like, what's the dollar market telling you?
Well, so I've been scratching my head at the dollar market because on a relative basis, the rest of the world's central banks were easing, and the Fed was, again, on a relative basis, tighter because it was immovable, stuck. So relatively tighter monetary policy stance, and the dollar falls out of bed. It tells you several things. The most eye-opening conversation I had with a client right after the election was, any way that I can express getting out of the United States, I will. Why? Well, because that man's going to destroy the country. Quote unquote. That's why I did the air quotes. I didn't say that. I'm paraphrasing a client. And so you had selling of US exceptionalism in any way that it could be expressed until the TIX data tells us it's stopped, reversed, and completely. So what does that tell you about crowded trades? That the only crowded trade left is the short dollar trade. Now, again, David, you're asking me fundamental questions. I'm giving you a contrarian answer to say, if the dollar weakened historically and materially when the Fed was relatively tighter, doesn't contrarian thinking tell you, and actually this is a QI call for this year, that the dollar could strengthen going into Fed easing?
Well, I could only think if you built the view that the easing is going to cause a sudden large reacceleration in growth.
Nope,
I
not
could
my
buy
point.
that. Well, I don't know. I don't know what the case would be. Besides the fact that, the peak, it is interesting because I'm certainly not bullish on the US economy. But then again, you're going to get incrementally a 50 basis point boost just arithmetically to GDP growth next year. The peak impact from the big beautiful bill is next year, and then actually in the out years, it moves to actually mild contraction. Look, here's the way I see it. You have very loose fiscal policy in the United States, and you have relatively tighter monetary policy, and it's the country that is embarking on the tariffs. It's just basic economics tells you that the US dollar should be strengthening, but it's not. This is the odd man in the room. For me, this is actually one of the greatest non-confirmations for the risk on trade. I mean, you said that the short dollar trade is the overcrowded trade. I think that the real overcrowded trade is the risk on trade in credit, private equity, private debt, and the public markets for the risk on trade.
We're not arguing that point,
Yeah.
Dave. I mean, everything.
That's the I'm just saying that the US dollar is the odd man out. The US dollar is behaving in a way. So when people say to me, where's this recession already? I mean, is the bond market? I mean, we've had bonds rally, but we're not down. We were at 360 last September on the 10-year note. You would say, well, the stock market, 23 multiple and record highs for the S&P. Credit spreads have no recession risk priced in. But the US dollar seems to me is priced against something a little different than all the other asset classes are. That's the way I explain it. It's just basically, look, I believe that your job and my job is to identify anomalies and try to find non-confirmations. But it does lead me to that question as to, you and I were discussing the recession for quite a while, the recession that never came. We were always skeptical that that beneath the veneer, there certainly were recessionary pressures that were building. But let's just tip our hat to the consensus. Recession never came, and now you have people like this competitor that I'm talking about actually said on TV that he doesn't expect a recession to happen at any time in the next 10 years.
Wait, Dave.
That's a case. Let me just continue. That's a case of the business cycle being repealed. But what I'm asking you is, have you abandoned your recession call?
No, go back to my first slide. It's not a call, it's data. The US economy saw net job destruction in the second quarter of 2024. That is not my recession call. It is hard data. The US economy, unless this time is different, has never avoided recession prior to net job destruction commencing. And it's hard data, Dave. There's no reason for me to abandon a call when it's not a call, it's data. That's the reason I put the first slide up there is because it shows net job destruction according to the reports by 12 million US employers. Not my opinion, simply their head count.
Well, so how do people like me and you then, when we're asked the questions from people in the markets as to how we could be in a recession, with credit spreads really where they were back in the late 90s, valuations in the stock market, like there's outside of the US dollar, can you identify a market variable that would confirm the view that we're in a recession? Because they're tough to find.
No.
The VIX wouldn't be at 14 if so then this is another anomaly then. I'm just wondering, when you're talking to your clients, I mean, the thing is that I'm trying to help them out. I mean, if we're in a recession, even in a plain vanilla recession, you're down between 20 and 30% on the S&P.
Right.
Yeah. So, but
I mean, Dave,
if we get 3%, if we get 3% down now, it's a massive correction.
my mantra with my clients and the way that I have learned to contend with the difference between reality and the markets is that we advise our clients to adopt one maxim: trade the narrative, own the truth. That's it. The market's going to trade off of whatever is reported on the White House lawn on non-farm payroll Friday as if it's the final number. That's how the market's going to trade that day. And that's how this market has traded. To suggest that regardless of which metric you use, again, valuation is not a timing tool. I get that. But when you add up every single metric out there and see that you're more overvalued than any time since 1929 or 1999, God himself is telling you, maybe it's a she, to trade the narrative. But just because you trade the narrative for the sake of your clients just because I dictate to my clients to trade the narrative and to embrace risk, because that's what markets are doing, doesn't mean that they don't need to own the truth. You always need to know where you are in a cycle, whether or not the markets agree with you, because data are data. We don't fight data. I don't fight data. I don't fight 12 million American employers' quarterly reports to the US Census Bureau. I take them for their word because legally they're obligated to report their headcount numbers. Granted, it comes with a massive lag, but the numbers are the numbers. And there were net jobs destroyed in the second quarter of 2024. That's recession. But it doesn't make a little bit of difference. I'm using very kind, polite, non-ugly words. It doesn't make a bit of difference to traders.
Let me ask you a question. So we have the situation where the employment data support the notion that we're in a recession, and yet the Fed is pitting the funds rate, call it what, 150 basis points above neutral. So when you speak to your friends at the Fed, I mean, your quotes say an insider, you've got, and you say that they get your research, and you talk to them. When you try to get an explanation as to why they're keeping policy so tight, so this has nothing to do with Trump bashing Powell over the head or anything else. This is about the Fed being unduly tight, and unduly tight because of tariffs, which are not really inflationary. And it doesn't matter if it's a 1, 2, or 3 sequence shock. That doesn't matter if it's a drip drip. It's basically still not permanent. We got to that non-transitory inflation in 2022 and 2023 for a variety of reasons. Fiscal policy was much more stimulative then, and we were reopening the economy, and then we were getting squeezed by supply shocks for about 18 months. But even then, people were saying it was going to be the 1970s all over again, and it wasn't a decade, it was 18 months. Maybe in the overall annals of economic financial history, that was transitory. I don't know why the Fed thinks that tariffs are inflationary when there's no evidence that they've ever been inflationary. And the 1930s sort of proved that they were ultimately deflationary. When you have these conversations with the Fed, what do they come back? What is their justification for keeping policy so tight?
So first of all, Dave, let me clarify here. Now, my former boss happens to be very good friends with somebody who sounded like he was reading my last week's weekly quill in Jackson Hole. I am not speaking to people inside the Fed. They do not want to speak to me after the book that I wrote. We're supposed to have kept those secrets secret. So let me just be really clear on that. In fact, my entire body of work over the last 12 months has focused on the discomfort being felt by Federal Reserve staffers, by the 786 some odd PhDs, by the individuals who have been told to look the other way. Look away from the Bureau of Labor Statistics. Don't look at BED. Don't look at QCEW. Don't look at benchmark. Don't. If you do the math, then we're going to know that we're in recession in Q2 of 2024. Don't look at it. What my body of work has been, because trust me when I say not on a single holiday list at the Fed, I can guarantee you they don't talk to me. I don't talk to them. I just happen to know somebody who knows somebody really well, who reads all of my research and hands him quite a bit of it. It's all I've ever said. What I can tell you is that this has not been a joyous time at the Fed. Adriana Kugler is a labor economist. I can only imagine how uncomfortable she was in the last few meetings in which she sat around that great, big, gigantic wooden oval table in the Eccles building, listening to the chair say, I'm going to maintain that the labor market is solid. as a labor economist when the preponderance of data said that it was anything but solid. It has to be hard to be Goolsbee. It has to be hard to be Collins. It has to be really hard to be John Williams. My gosh. It has to be fingernails on the chalkboard for Daley. Kashgari, he'll do whatever anybody tells him to do. But it's got to be really hard for the doves in that room to listen to Powell say, I'm going on national television. I'm going to maintain that the labor market is solid when you, me, and the rest of us in this room know that it's anything but. That's what I've been writing about for the last 12 months, Dave.
So that brings me to the elephant in the room, which is Donald Trump's constant attacks on the Fed, the Lisa Cook situation, the constant badgering of Powell, the open seat, Stephen Myron being nominated, who was obviously a huge Trump supporter. He was actually, notwithstanding what you were saying before, Myron was actually openly criticizing the Fed for cutting rates last fall. And now he wants to go 50 basis points in September and keep going on a steady diet. How are you seeing all this playing out right now at the Fed? How's the makeup going to look like? You mentioned before that Powell might stay on as governor, but who do you think is going to who would be your choice, or who do you think Trump is going to choose for the Fed chairmanship, and what extent do you think that's going to matter?
So, first of all, you asked me what's going to happen at the Fed right now. And
Well, right now, I'd say over the next, say, starting now to the next 12 months, how are things going to change?
so I don't think they're going to change a whole heck of a lot. There was a glimmer of hope for the president when somebody whispered into his ear that Cook's term ends in 2038. And he was like, oh, let's put my man in there until 2038. Go team. And then somebody whispered in his other ear, sir, no charges have been brought against her. Yeah, minor detail. So everything on the wires today says that the Senate Banking Committee is going to move expeditiously starting Tuesday to fast track Moran through the confirmation process for the only seat that exists that expires on January the 31st. So that's the only change right now that I'm willing to speak to. And it's not because I'm being stubborn. It's because, to answer your second question, I do think that of all of the people being considered, that Christopher Waller is probably right now the front runner. Somebody on the inside. That's where my money is. He knows he's got Michelle Bowman in the right place, or at least, excuse me, Bessent knows that Michelle Bowman is in the right place, at least for him, as head of Bank Soup and Reg, vice chair there. That's where Wall Street wants her to be.
Mm-hmm.
So the current dream team would be Waller as chair and Bowman as vice chair of Bank Soup and Reg, keep Jefferson where he is as vice chair. And then we wait and see what happens with Cook. We wait and see what happens after January the 31st, if Trump wants to throw somebody else in there. We wait and see if Powell actually leaves in May. And I would agree, Powell's aged a decade and a year. He likely is the last person in the world who wants to stay on through January of 2028. But would he do it? Would he do it for his country? Would he do it to safeguard the sanctity of Fed independence? It's all very possible, Dave. It's all very possible, because when you line up the dominoes and have a majority of yes men and yes women, then you can change the entire makeup, composition, future of the Fed all the way down to all district presidents whose 5-year terms come up on February the 28th, 2026.
Well, I think that if you're right, I think Waller would be a very pleasant surprise. But what if it's like, why would Trump bother taking Myron away from his current role as de facto chief economist at the White House, put him in there with the view that he's just there till the end of January, and then that's it for him and the Fed? Unless maybe he's thinking that what he will do is maybe appoints Myron to head the Fed. Like, how would you explain why you would sacrifice somebody on the inside, an economic advisor to you, put him on the Fed for whatever, 5 or 6 months?
Right. But you're also, the flip side of that coin is he's willing to go there. Right.
Well, let
So
me
he's
ask you a question.
obviously willing to be the yes man.
Who would you go? Would you tell us who you think would be on the list, people that would cause you concern?
Probably not Dave, but anybody who toils away on Wall Street in a position where they monetarily benefit from having certain views, that would bother me.
We won't use any initials.
We will not, Dave.
Okay.
And the
Well,
whole world knows exactly what I'm saying.
I think that I have a strong clue as to exactly what it is you're saying. Okay, we're getting to the top of the hour, so Danielle, this went by really quickly, which is always a great sign. Thanks for this huge contribution today, or I should say tonight, based on where you are. I don't see a glass of Chianti. Maybe it's nearby, but
I'll be getting there quickly.
I was in Italy almost exactly a year ago, and so I'm a little jealous. But this is really just a great webcast, and I want to thank you again for your incredible contribution. It serves me as a reminder that I need to get you back on the webcast again before long, maybe May of next year. So just a quick question before we go. Where can people on the call find you?
Please come to QI Research, especially if you're an institutional type of client. Our Bloomberg chat room is on fire every day, even when I'm hours and hours ahead of the clients. And if you want an institutional level retail offering every day, then please come join the Daily Feather community as well. DiMartinoBooth.substack.com. Love to have you.
Okay. Trade the narrative, own the truth.
Trade the narrative, own the truth.
Love it. Love it. You're going to have to patent that one before I steal it from you.
It's already gone kind of haywire on Twitter, which means that I follow you much more closely than you follow me.
Okay. Well, just before we adjourn, a reminder that the next webcast is going to come our way on September 18th at 4 p.m. I'm going to be hosting Greg Epp, who I would argue is, Danielle might have an opinion too, but I think he is the best economics and markets commentator over at the Wall Street Journal. He is
100%.
excellent. I've known him for over 30 years. He's got tremendous insights. So I sense that one's going to be, shall I say, a very educational follow through on U.S. policy from what we heard today from you, Danielle. So till then, everybody enjoy the rest of the summer here in Toronto. I can feel it slipping away already. And that concludes today's webcast.